Good day, fellow investors. A few days ago we discussed compounding as one of the most powerful forces when it comes to investing. As would Buffett say, just let the earnings, the interest, the dividends compound and you will do extremely well. Today I want to continue on this Buffett mindset investing mentality, Buffett's investing mindset, by discussing patience and discipline and discussing the whole example of Buffett and his ventures with Coca Cola. In a future video I'll discuss, I have already prepared 15 to 20 Buffett's mistakes, so be sure to subscribe to get the whole complete Buffett's investing mindset series and watch that, because it's all about mindset, it's all about character, right?
Warren, what do you consider the most important quality for an investment manager?
It's a temperamental quality, not an intellectual quality. You don't need tons of IQ in this business. I mean, you have to have enough IQ to get from here to downtown Omaha, but you do not have to be able to play three-dimensional chess or be in the top leagues in terms of bridge playing or something of the sort. You need a stable personality. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd, because this is not a business where you take polls. It's a business where you think. And Ben Graham would say that you're not right or wrong because 1,000 people agree with you. And you're not right or wrong because 1,000 people disagree with you. You're right because your facts and your reasoning are right.
Now let's talk about this character by discussing the story of Buffett and Coca Cola. The story is very intriguing and interesting because the story of Buffett and Coca Cola started when he was 7 years old. But why I don't let Buffett tell the story again?
Picture Omaha in 1937. I was 7 years old and no air conditioning, so the summers were hot and humid. People went out on their lawns at night just to try and cool off, and I got the idea that maybe I could sell them what you would call soft drinks and we called pop. So I went around to a bunch of gas stations, and in those days every gas station had a cooler with varied soft drinks in it, and it had a little opener on the side and something to catch all the bottle caps. So I went around and collected all the bottle caps for weeks at these various gas stations. I collected 8,000 of them. And then I sorted them all out, and I saw that they were Coca-Cola overwhelmed everybody else. So I decided to hook myself up to them. And they were these little silver-like ones in those days. And my grandfather had a grocery store, so I went to my grandfather and I said, how about giving me a deal on Coke so I can sell it around the neighborhood? And he sold me at the rate of 6 bottles for a quarter, and I went around and sold them for a nickel each. And I sold out every time. And I had no inventory, I had no receivables, I had the best business I ever had. But I made one mistake. I didn't put the money I saved into Coca-Cola stock. But I rectified that mistake some years later.
So that some years later is exactly 50 years later. Buffett waited for 50 years to buy a company he always liked. And why Buffett didn't buy earlier is a very important question, but the answer shows the discipline and the patience Buffett had to watch something for 50 years and not touch it, but then buy big. More about the story about Coca-Cola and everything else Buffett has been doing, you can read in the Snowball, Warren Buffett's biography, autobiography almost. So I urge every investor to read this book to get the right mentality when it comes to investing. Buffett's life is in here, so there is so much to learn. Let's continue with our story on Coca-Cola. Buffett didn't buy Coca-Cola earlier, but still the stock did very, very well. The stock went from an adjusted price of 5 cents in 1962 to a price of $1.2, again adjusted to the current price later, when Buffett was buying. And the problem is that it was always a bit too expensive for Buffett. Buffett bought at the moment that it was cheap for him, because it seems that he's willing to buy a great business at a price-earnings ratio of 10 with a forward price-earnings ratio of 10-ish, 12-ish. The historical average price-earnings ratio for Coca-Cola is 20. And you can see in this chart that for the majority, when Buffett had his investment fund partnerships, the price-earnings ratio was highly above 20, even reaching 40. Then, mid-70s, late 70s, it dropped to 12, even to 10. But forget about the 1980s, early 80s, because inflation was very high. Buffett was buying great businesses at price-earnings ratio of 5. But then in 1987, the average price-earnings ratio was already higher, and suddenly Coca Cola dropped to a price-earnings ratio of 10. Forward price-earnings ratio of 10. I believe the price-earnings ratio was 12 to 15 at that moment. And then Buffett started loading and bought big. He bought so big that 21% of Berkshire's capitalization was in Coca-Cola stock, and he bought about 35% of his outstanding stock market portfolio during 1988, 1987, 88, 89. He made a deal with the Securities Exchange Commission that he doesn't have to report such buys because that would spike up the price, and when he disclosed his buy, the stock of Coca-Cola really exploded in 1989. What's also very important from value investing, Buffett paid for Coca-Cola a price to book value of 5, which someone would think it's huge, but it was about the businesses, about the business, about the cash flows, about the dividend, about the future potential earnings and future potential growth. And where did Buffett find that margin of safety was in the brand value. There is rumors that he was reading some branding material, and they said that to replicate what Coca-Cola had back then in the 1980s would take $100 billion. Buffett was saying, okay, the market value of capitalization of Coca-Cola is $20 billion, and I'm buying something that has a brand value of $100 billion, so there was his margin of safety. The message here is that when you find a great business, a business that you really want to own, you put it on the watch list, and when that business, for whatever reason, falls at the level, okay, now I'm very happy to own that business, then you buy a lot of that business, because over the long term, if you own a great business, that's all you need when it comes to investing. And Coca-Cola has been a very good business, excellent business for very, very long time, since 1919, when it went public, as the owners bought it for 25 million, so just 25 million 100 years ago, and then the rest is history. How did Warren's investment work out? Well, I would say pretty well. Since then, the stock has increased, what, 40 times, plus the current dividend yield, I think it's 50% from what Buffett is getting at the moment. So giving the buybacks, giving the everything, he's getting a huge return on investment every year that he can redeploy wherever he finds fitting. Another example of patience, the stock practically didn't go anywhere between 1997 and 2010. That's 15 years if you include the starting and ending years. 15 years of nowhere. Do you have the patience to look for 15 years of nowhere? And the message here is, first, don't judge Buffett on buying Apple, buying IBM, and that's something we'll discuss in probably next week, a video discussing Buffett's mistakes. Don't judge on the fact where the stock goes. He doesn't buy the stock, he buys businesses, and this is the crucial fact that many miss, and he buys great businesses, and that is the key reason for his success. So to conclude, just invest in businesses, give them time if they are great businesses to grow, to do what they are supposed to do, and you don't have to care about anything else for that matter. And this is exactly what we focus on this channel, having the right investing mindset to find great businesses, and then when the time is appropriate to invest in those businesses, invest a significant portion of our portfolio. Thank you for watching. Please subscribe if you liked, click like, comment, ask questions. We are here to learn together, and I'll see you in the next video.